Good afternoon, everybody. Welcome to the webinar today, Protecting Your Retirement Account in a Correction. Glad you guys are here. Hopefully we can be a bit of an encouragement to you in this wacky market. This is for educational purposes today. We'll be having a new course starting next Thursday, March 5th. And it's a little bit of what I'm talking about today, mainly going over a few strategies with you. Let's just give you a little bit quick information. This will be on this topic, protecting your retirement account in a correction. And this will be a great learning opportunity. Not many of you have been in a down market or kind of a volatile market like this, and it can last a while. And I thought it would be great learning experience for you the next 3 to 4 weeks. We can go through this together. Mark Fenton and I and Jay Bailey, two mentors that have worked with me for a long time, will navigate with you through whatever the market throws at us the next 4 weeks. I think it'll be just a great opportunity, and it might be a help overcoming your fear. How many are in your bunker right now? Well, starting Thursday, we're going to go through this together, and I'll be putting on live trades every class. And again, our hallmark at Sheridan Mentoring has always been on risk management, and I think this will get you out of the closet. It'll get you out of the bunker. These are the class dates: March 5th, 10th, 12th, 17th, 19th, and 24th. Usually go about an hour. Tuesdays and Thursdays, all classes will be recorded in case you're working. Question Q&A during class, non-recordings. You can go to class page and click on a button that says Ask Dan a Question, and this could be 3 months after the class. So I think this should be just a great class because it's going to focus on high volatility, whippiness in the market, but something most of you haven't had a lot of experience with, just because we've been going up for about 7 years. The downside and a correction and dealing with all of that. And I think this would be a great learning, and I think you'll be a lot less fearful when you go through this, how to survive during this period. These are some of the topics that will be covered during the new class starting Thursday, Protect Your Retirement Account in a Correction. That's next week, Thursday. How to make a simple trading plan in a correction. Dan, I'm in the closet. I'm hiding out with my distilled water. Hey, let's make a plan. Follow a plan. You're not just going to wing it. How to overcome my fear in a correction. We'll talk about that. A lot of it's just having a solid plan with risk management. What are the big differences between trading strategies on the downside versus the upside, or in a volatile market? They're huge. They're big differences in terms of, and you've seen it yourself. How much more difficult it is on a downside. And again, even if you read the Wall Street Journal today, the front page, I don't know how many you did, it is different than most. And what did they say? This is the fastest we've ever gone down 10%. Took 6 days in the SPX versus, for example, the last correction we had, which was in the end of 2018, right? That took 45 days to go down 10%. So this is, this can wig you out. Right? In a declining market with higher volatility, how do you set up collars and covered rights? Right? How do you do that? Can you still? I think there's some tremendous opportunities for, you could set up some covered rights. I'll show you an example where you can get 8 to 10% downside protection from here, right? And if you want even more protection, you can get it. But again, the key the nice thing is most of you are afraid to even turn your computer on and hit a button. What we're trying to do is get you from underneath the bed, right? And look at trades, and we're going to force you to analyze the risk, analyze the trades. We're going to look at trades we would be comfortable with, right? And so for some of you, the first step may be, okay, Petru or Art, we're going to have you turn the computer on, right? So it's look at where are there opportunities here. And it's, with the high volatility, it does create some pretty good opportunities. I'll be putting on live trade examples in every class that me will give clear risk management plans on. And again, we'll talk about, because of the high volatility, how can you make potentially higher yields on less capital? So, it's just looking at this. And how to trade cheaper option alternatives to cash secured puts and covered rights in a high volatility environment. How do you trade butterflies and iron condors in a high volatility environment? And it's a whole different ball game. And most of you haven't been doing it because we've been going up for 8 years. How to trade calendars in a high volatility environment. You can trade them. And we'll go over how you can trade them. How do I set up trades to withstand big daily moves amidst my shaken nerves? And these are all real things that we'll be dealing with together over the next 4 weeks. How to trade credit spreads in a correction environment, right? And I'll talk about an example of a hedged one today. One other thing I'll bring up in a few minutes is, again, like anyone else, how simply you can avoid some of the, in terms of these range-bound trades. How do you not get killed in something like this? And many different things. With a big decline and people are long stock, how to create a free stock opportunity on the upside if you're long stock and we go back up, right? And I'll show you how to do that with ratio spreads. How do I handle bad execution in a correction? And isn't that the tough thing? Which you don't get on the upside. And again, your best friend in corrections and extended periods of high volatility. And I want to talk extensively about something we've preached for 15, 20 years in Sheridan Mentoring, is how to use a long put. Long Vega and short Vega hedges, like ratio back spreads and short calendars, best spec trades, betting on a stock market recovery. So we're going to give you the whole ball of wax here in the next month. And I wanted to get this started next week so we can work together and help you look at this. And again, as I've always told people, great option traders are not great option traders, they're great risk managers. And so we're going to deal with risk management and setting up trades that we would be comfortable with, and learning a lot more about this high volatility correction environment. Here's an example when I took with SPX about a half hour ago at 29.36, down 41 points, 6-month price chart. You have to ask, what's SPX now? Because things in a half hour can change a lot on a day like today. What's SPX at now? 28.90. Okay, yeah. Down about 80 something. So yeah, it's moving around. But if you look here, I just want to point a couple things out. Here's a 6-month price chart in SPX, and how do you know? As you're going through this very gentle SPX, this is a 6-month price chart. How do you know that this is going to happen? We didn't know, right? No one knows, right? But again, as I always say, I was just out in Huntington Beach doing a seminar in San Francisco, but if you're in the water and you're surfing and there's 4-foot, 5-foot waves and the waves go to 30 feet, is that public information? Yes or no? Are you aware if the waves get a lot bigger? Yes or no? Yeah. Are you aware in Chicago if you're driving and suddenly 15 inches of snow comes? Is that public information? Are you allowed to pull off the side of the road in 15 inches of snow? Are you aware if are you allowed if the waves are getting bigger? Do you have to be a nuclear engineer at Stanford to know when the waves get higher, or the snow comes? No, I don't think you need to be a nuclear engineer to figure that out, right? And do you need to be a nuclear? No. And when did we, during this, using some basic parameters, and we'll be talking about more of them during the class, but some basic ones we use for the range-bound part of our portfolio, iron condors, butterflies, as we're going through here, were we aware we were at all-time high or near levels? Yeah. Were we aware that something big was going to happen? Absolutely not, right? But are we allowed to see when the waves get bigger or there's a lot of snow? Yeah, that's public information. I mean, so if you look here on this, let me just find it because I put a note there. If you look here, everybody see this little doodad here? I don't know what you call it. It looks like a red plus to me, but what's significant about that? That was January 27th. Cameron and Lucky call it a doji. I didn't know it was a doji. I wouldn't know a doji if it, and Charles says it's a doji with a spinning top. I wouldn't know if it was a doji with a spinning top or if it was a hamburger with ketchup and mustard. I wouldn't know. But I did know something on that day, some basic parameters we have in SPX. As we're doing range-bound trades, if ATR hits, which is the average true range, which measures the width of those candles on a price chart, that hit 27 and VIX hit 18. And on that day, when it hit those, what do? We back off of short-term trades, 7 to 15 days out, and we don't do any new trades for 3 to 5 days. Right? We wait to see if the weather's conditions change. It's warning us, right? It doesn't mean again, there could be false warnings at times. It usually isn't with these two, but basically from that day on January 27th, that was our kind of warning, and we've basically been out of short-term trades since then, and even longer-term trades, even though there's been some dabbling. And you can see even on April, now VIX, ATR didn't, even during this period, ATR didn't come down. But if you look at VIX on Feb 21, because VIX did come down as we were kind of balancing here. But on 221, which is this, can you guys see this one? This is another one. Can you guys see this? This is SPX. SPX 6-month price chart, right? You see this one? Again, VIX went over 18. So usually these two guidelines keep you out of most trouble. But the point is, did I think this was going to happen? No. Never happened before. I don't know. But again, it got us out of trouble there. And again, we've talked about downside adjustments for years and years. A lot of the students bought long puts as adjustments on the downside. So we talk about that all the time, and that really helped, right? But anyways, that's just a couple points here, and the point here is just that you don't have to be a doji expert, right? Dojis are good, technicals are good, but what I'm saying is, can Joe Common person recognize when the waves get too high or the snow gets too much? And the answer is yes, right? Agree? VIX 45.5 up 6. I haven't seen these kind of volatilities in a long, long time. Again, as my Irish grandmother would say, this too will pass. And she was dealing with problems. It could take a while, right? But again, use this as a learning opportunity to learn something you haven't had to learn in the last 8 years, which is how to deal with a down market, a correction, a high volatility, and it's totally different, right? So just a couple examples so we can just talk about some trades, right? Here's a Costco covered right. I'm just looking at a few things in this high vol environment. Here's a covered right with about 8.5% downside protection. I looked at Costco at 281. What's it trading at right now? This was a half hour ago. COST. Maybe if someone could tell me what was it trading at. We're just talking a few trades here. We'll be talking about a lot of different things in the class starting out. Marilyn said 279.53. Thank you. So here's an example where Costco at 281, and again, instead of buying stocks, if you buy 100 shares of Costco, it's going to cost you $28,100. That's a lot. So instead of as an alternative to doing a covered write, instead of buying 100 shares of stock at $28,000, you can buy one April 17 in the money 240 call, an 80 to 90 delta, and we'll talk about that, as a stock surrogate, which is going to be much cheaper than stock. But what I'm doing here, unusual, most people, when you do a covered write or something, you're selling an out of the money call. Here, I'm selling, one of the advantages of high volatility environment is the premiums are jacked up. You can do these in the money covered writes and get tremendous downside protection. Here I'm selling there wouldn't usually be $16 in the money in Costco. You're not going to have a lot of premium. But if you sell a 265 call, $16 in the money, this whole diagonal is going to cost $20.65. So about $2,000, little over $2,000 to do one covered write alternative where you're buying an in the money call versus stock. If you did one covered write, instead of spending a little over $2,000, you'll spend over $28,000. But the point is, if you look, your downside protection here is you're getting about 8.5 downside. Costco's at 281 over the next 30 days. You have downside protection almost to 257. You guys see that? You see the downside. This is where the underlying is now, around 281. You see the massive downside because you're selling an in-the-money call. You guys see that? So there's, it's important that you do trades where the volatility is in your favor. What we're going to be doing over the next 3 weeks, looking for opportunities in the market, all well risk-defined strategies, no naked options. And I just think it's just a unique opportunity for us to go through this together. And I invite all of those who are, if you're hiding in a closet, you're hiding in a ditch in back of your house, you're under your bed and you're saying, you tell your wife, just give you food and give you a little bit of water over the next 3 weeks till this. Don't miss this opportunity to learn, right? This is, it's like a baseball player, his whole life, right, is only hitting right-handed pitchers. You're going to have to learn at some point how to hit left-handed pitchers. Again, this is April 3rd. It's about 30 days out. No, if the volatilities are a little higher, I want to go a little bit further out. Somebody said, isn't April 3rd too far away? No, you get more premium. And with the volatilities high, I want to go a little bit further out. And if I go a little bit further out, it gives me a little more cushion. So this is an example of something positive, right, that you can get a lot of downside. And we'll talk about if somebody, if you look at this on 15 deltas long, if somebody said, Dan, I'm still concerned. I know this has got 8.5% protection, but, the mind gets a little crazy in this environment. What if I want more downside protection, right? What if I, can I buy a put? And I'll show you how to add a put to this so that if Costco goes to minus $42,333, you're fine, right? Really limit your downside. Again, this gives you 8.5% downside. We're 15 deltas long. If you want to still be long and make money on the upside, close up the downside and have extremely limited risk on the downside, we can do that. We'll go buy a put, right? So again, part of it's getting your comfortability, but the other thing is we want to make sure we design strategies that if the market does recover and we go up, volatility is going to get destroyed. And so we want to, again, when you see when we're talking about strategies over the next week, and it'll be Mark and I will be on there, then we'll bring Jay on, but it's going to be like we're making a cake or we're making a pasta, fettuccine Alfredo. The right ingredients are important, right? Because if you think you're putting on something, some strategy, and you're on the wrong side of volatility, you're going to get destroyed. So Gil says, how do you get 8.5% downside protection? And it's because you're getting such a high price, Gil, for your 265 calls. right? Because we're selling calls that are $16 on in the money, they're a very high price. So that gives you the cushion. That's where you're getting so much room on the downside. So that's where the platform is calculating a downside break even where the expiration graph crosses zero at expiration, why it's so far down, like 256, 257, and we're at 281. Because a typical covered right is, you sell a call for $3, you get $3 of downside protection. What if you sell a call for $18 or $25? Why did I use the different expirations that I use there? Well, again, it's constructing a trade. I bought April 17s only 14 days further out than the April 3rds. What would be a reason I didn't go 6 months out on my long? Who can give me a reason why I didn't go 6 months out on my long? Even if I'm in the money. Anybody? Volatility. So again, it's very important as we'll be making strategies over the next 3-4 weeks, that we're designing them so that if the market drops a lot more or it goes up, that we're considering what can bite us in the fanny, right? So I think that'll be a wonderful learning for you. Another quick strategy would be, who does credit spreads? How many of you guys do credit spreads? And we'll talk quite a bit about this. Any of you do credit spreads? If you set up, here's an example. I just whipped these up real quick so we can talk about trades, but which we'll be doing a lot in the next month. But here's an example with SPX at 28.93. We're looking at an April 17 credit spread. Just focus on this. April 17 credit spread. How many days out is April 17? How many days out is April 17? How many days out is April 17? Anybody? 45, 49, 50, 85. Well, you guys are bad. How about 49? Let's go with 49, 48, 40, 49, 48, 50, 80, 90. All right, let's go with 49 days, all right? Let's say this. In your lifetime, you may not do, this might be the last time in your lifetime or mine that you're able to do a 49-day, exactly like I'm doing it. Let's say a credit spread and get as much room on the downside. For example, we're at 28.93. I think I sold here maybe around a 20 delta for a short put, and I bought my long put hedge 20 points away. So just focus on this part, credit spread. Sell 3 April 17, 25.60 puts, buy 3 April 17, 25.40, 3 credit spreads 20 wide. Everybody get that? I'm getting $365 credit. And my risk on this credit spread will be the difference between the strikes minus my credit of $365, which would be, $1,635 of risk. Are you guys with me on the credit spread? Does everybody understand what I'm doing with the credit spread? I'm picking my short strike at 25.60. I used a 20 delta. It's 20 wide, just this part. And so with us at 28.93 and a 49-day trade, I'm selling this put in New Zealand. What do you mean you're selling the put in New Zealand? The put is 25.60. We're at 28.93. That's 333 points out of the money. So for this credit spread, this duration, this delta of the short put, I haven't seen anything like this. Is 10 wide better or 5 wide better or 20? No. There's none better. Depends on, the size you want to trade and whatever. But let's get into this. So I've got these 3 put credit spreads, but How many of you would still be nervous putting a put credit spread on a day like today? How many of you would still, with this could be far from over, how many of you going into the weekend would be scared putting this on? Yeah, and I have some, again, I have some fear in me. So how about if we said we're in a high vol environment? How about if we could go in there and buy one April 17, 1700 put? It's only one delta at $4, right? You guys see that? So I'm buying a hedge. This is my hedged credit spread. So what does that mean? It means if SPX opens up, right, opens down, if SPX opens down 234,500 points Monday, will we be okay? Let me ask you a question. If SPX opens at 0 tomorrow, will you make or lose money? Yeah, you'll be doing well. So again, so it's creating trades that, and let me ask you, if SPX goes up 1,000,000 points Monday, if SPX goes up 1,000,000 points Monday and the VIX comes out 30 points, will you be okay? Now, John says if you can get filled. Well, so here's how I would do this. I would just go in and sell the put credit spread, get the price you want, and then I'd go buy the put. Now, Zach says you lose your $4.35. I'm not sure how you lose $4.35, Zach. How you would lose $4.35. The put is $4. Now, when do you lose that put? When do you lose $4? You lose $4 right away, or how do you lose $4? You lose $4 at expiration, right? Is it? But again, if you look at the upside, right? Let me ask you, does this graph, right? Here's the expiration graph. Here's your T plus 0. Does this graph include the long put? Yes or no? Does this graph include the long put? Let me give you the answer. Yes, right? So if we go up 1 point or 232,334.7 points, we make money, right? Let me ask you a question. Is that $3.65 credit for one spread or three spreads? Is that $3.65 credit, is that good for one spread or three spreads? That's per spread. That's, agree? That's per spread. So we're making $365 times 3, right? So on the upside, is that enough to offset the $4 put? Is $365 times 3 enough to offset $4 bucks? Right? As they say in Iowa, till the cows come home, right? So all I'm saying is, and here's the fun part, and that's why I want to invite you to come through with Mark and I next week, is we're going to have these discussions, force you to come out of the closet and work on the craft together and work on your downside, work on your volatile market. I think this will encourage you the rest of the year. This is, Wayne says, would you put on SPX way out of the money put credit spreads to expire this coming Monday because IV is so high, multiple contracts? The question is, how many of you would put on way out of the money put credit spreads that would expire on Monday because the IV is so high? And we can look at it in a second. We could talk about that, right? But again, this is all about running a business, right? Not a lotto shot. I mean, it's interesting, but we'll talk about it, and I'll give you my opinion on that. Wayne, I mean, there's nothing wrong to bring up, but it's let's look at it, right? We've got to look at it and address it. We'll look at one more quick trade. And again, I want to encourage you. Johnny will have, I think John Schenkel, who works with me, my nephew, will have on our front page, you'll be able to sign up for the next Thursday's class starting today. I think he might even put if he's on top of his game on Friday, he might even have something in the chat that you can click on. But if you go to Sheridan Mentoring, there should be some information. You can sign up for the class. I just think it'd be a great area. Oh boy, he's on top of his game. He put the link in the chat that you can sign up for the class. It's $297 for the 3-week class. We'll meet twice a week. And again, you can ask as many questions as you want on the website or during class, and everything will be recorded. But I think this will be a good learning. Here's an SPX Iron Butterfly 100 wide. Again, opportunities that come up because the volatility is high. But if you look at this, we're selling your most expensive options, your at-the-monies, because they have the most extrinsic value. So we're selling the at-the-money call, at-the-money put, and the at-the-money call. Why? Those have the most extrinsic value. With the VIX at astronomical levels, that's what we want to sell, right? What is that called? If you sell an at-the-money call and an at-the-money put, what is that called in option parlance, right? What is that called? You sell what's the short straddle? So the foundation of a iron butterfly is a short straddle at the money because it has the most extrinsic value. Against it, in this high volatility environment, I'm buying my hedge 100 points out of the money. You see that? I bought an out of the money put and call. And so your risk, the way they determine your risk at a brokerage firm, the difference in the strikes. So we have $10,000 of risk in this trade because the width of the credit spreads, you have a call and a put credit spread. What's the width of the spread? What's the width of each of these credit spreads? Anybody see that? What's the width of the credit spreads? 100, right? So we have $10,000 of risk less we're bringing in a credit of 9,200. So our maximum risk, if SPX goes to 0 or 242,114, be $800. This is the P&L. This is your graph at expiration, right? This is April 17, right? This is your risk in 49 days. And this purple line is your graph now. So literally, and you can see here, if we jump up almost 100 points or down 100 or whatever, our deltas barely change. We start out 2 deltas short, get nice positive theta. We're short, a little bit of vega, but you can see I don't have to look at this 100 points up or down. They're very limited risk. I probably would treat this as a no touch. I wouldn't do anything. Again, it's so far out. Again, in this environment, because I'm setting it up this way, and I'll go over more in the class how we would manage it. But again, to me, these are low risk type trades. Plenty of room, right? It's not like if it goes 40 points against me, I got to do something. Your wings, I don't even, I've got, before this even goes against me, you can see the downside. We better be in, north of Moscow before even looking at the thing, right? Zach says theta is too low over 49 days. No, you're not going to find, normally in this lifetime, are you going to find 49-day trades that have theta over 5 or 6? No. This is unusual, right? This is for a 49-day trade. That's pretty good theta. on $800. Anyways, so that's good. Let's finish with Wayne. Wayne wants to jump to the dark side, but let's take a look because again, it's just looking at these trades, right? So let's take a look and we'll finish on this. So let's say we look at, here's Think or Swim, and Wayne was saying, all right, well, we'll see how many of you guys would do this trade. Let's take a look at it. Gary says, are you concerned with Costco earnings on 3.5? Yeah, I would look at it, but again, a lot of I just gave this for an example, Gary, but a lot of these long diagonals, you're doing these because normally you would do a covered right in Costco or something if you like it over time, over the next 2 years, like if you like Microsoft over the next 2 years, or you like Costco. So this is something you'd be doing on a regular basis, not once in a long time. But I wouldn't be that concerned personally with Costco earnings, only because these stocks have gotten so battered as it is. And again, I'd get another 8% downside protection. So no, I wouldn't be. But if you look at SPX, Wayne, were you talking about a butterfly or an iron condor? What were you talking? Are you talking about selling a put credit spread, right? So here's what Wayne was saying. If I understand what Wayne was saying, let's see. So Wayne said, hey, Dan, let's look at March 2nd. That's Monday, right? You with me? And let's take a look. So Wayne was saying, hey, Dan, March 2nd is this coming Monday. What if we sold a put credit spread so far out of the money your nose would cave in? Let's go look, right? So let's say I sold let's take a look, and I'll tell you my thoughts on this. Let's throw, for example, let's say a 20 delta put, right? I'm going to sell the 27.95 puts, right? Well, let's go further out of the money. Let me just see. Let's say a 15 delta put, the 27.50s. All right, let's talk about it, and I'll tell you what my thought would be. So here's the spread, folks. You ready? Let's see who would do this, and then I'll talk about it. Let's ask you who would do it, and then I'm going to talk about what I would do. SPX is at 20, SPX right now as we speak is at 28, 29, 28. Let's get your ducks in a row. 29, 28, and you're selling the 27.50 puts, and you're buying your hedge at 27.40. So you're selling a put. I think we chose a 20 delta. We're selling almost 200 points out of the money. And let's see, that's 200. So that's about 6%. Let me ask a question. How many would be comfortable between now and Monday with 6% downside more in the SPX? Yes or no? Just yes or no. How many would be comfortable? All right, so most of you think, some of you think that we could drop another 6%. Now here's the key. Can we have a black swan event over the weekend? Says Petru. I don't think so. Let's just say probabilities. How many black swan events have we had? Let's say Petru. Petru, how old are you? How many black swan events do you think we've had in Petru's life? How many? How many black swans have we had? He's 47. In 47 years, how many black swans do you think we've had? 2. So is that a high probability event? Is it a high probability event that we're going to have a black swan event over the weekend? No, but let's be honest. Because of what's happened the last week, are we concerned? Yeah, but it's still very low probability, right, that we're going to move 6% by Monday. So here's the thing. As a risk manager, Now, your risk in this trade is $1,000 less your credit of $1.15. So you have, what, $885 of risk. Here's how I would approach this one. So we're just talking about one trade. Do I think there's going to be a black swan event over the weekend? No. Do I think we'll be 6% lower Monday? No. But could we? I'm running a business here, right? The question is this: Wayne or whoever said yes, here's where the problem comes in. Because it has the risk reward isn't great, and because, here's the thing, this is like an earnings thing, right? Either we open up, Monday morning, if we open up down 5% or 6%, again, very rare, but I won't be able to adjust. So the question is this: how many would you do? For the people who said yes, how many would you do? You've got about $885 of risk, tremendous probabilities in your favor. But because of this, no one knows what's going to happen over the weekend. How many would you do? Do you see the point? It's like an earnings trade. How many would you do? Right? And so to me, if you said to me, Dan, would you do this? I might. How many would I do? How much am I willing to risk? I might say, I'm willing to risk $2,000, right? Or something like that. Now, Wayne says, Dan, why don't you put on a call credit spread that would expire Monday to protect the put credit spreads? But then, again, you're getting into how many, you've got $885 of risk on the downside. You do 8 call credit spreads, right? To protect that for $1 or something. And what if it does go up? You don't get as much room on the upside as the downside, right? So again, very intriguing. But again, it just comes down to, because of the gap potential, right? Again, very low probability. The question, how big are you willing to do it? Whereas if you asked me a hedged put credit spread, put it on. Would I put a hedged put credit spread on or something? So if I was going to do this, I'd put a hedged credit spread on. I'd do bigger size. Anyway, as you see, lots of discussion. I want to invite you to come next Thursday, 1 Central. Even if you're working, sign up. Classes will be recorded. I think it'll be very worth your time. Again, $297 over the next month as we delve into handling your retirement account in a correction and all these trades you can do in a retirement account. All right, folks, thanks for coming in. Thanks for being part of this. We look forward to, I think, one of our better classes starting next week, Thursday. We'll see you then. Thanks.